Okay, so we ran a quick contest this morning, and on the Discord server, it was for the first two people to plot me their trades, send me their trades. I'd do a quick trade review for them, do a quick video, and so congratulations to Martin and Jerry for being so prompt and so quick on sending me their trades from a maybe a session of not today or maybe today. I don't know. So I'm kind of looking at this for the first time. And I did this on purpose to record this at the first time without actually looking at it so that I could give you guys my raw knee-jerk reaction to your trading as opposed to really kind of studying it and kind of formulating some answers. Because I think sometimes as we trade, most of the time as we trade, that's the better reaction, right? We need that quick response to the market or answers, that quick response to the answers that the market is giving us, right? The market is moving so quickly, so we need to be able to adjust on the fly. And that's kind of how I kind of look, review, and analyze trades. And I said this on Discord, and I'll say this again, that I am so kind of pleased with the progress of everybody in Discord. No longer are we asking the basic questions of how to trade, where to place a trade, when's the best time to get in, get out, all that kind of stuff. And although we do have a lot of new people coming on with those same questions, we're now starting to get the evolution of those questions. Evolution of the questions that have already been answered are not being asked again by the same people. And so they're incorporating that into their trades. They're getting better as a trader. And now they're asking the question, what about market structure? And I said that I've noticed a common theme amongst all the traders out there. And it's not really one that you might expect. Instead about asking when to get in or out of a trade, now many of the traders are curious as just how to identify market structure and the challenge that a change brings. You know, and honestly, I'm not gonna lie, this is one of the toughest things to really figure out as a trader. And it does, in most cases, take a rewiring of that brain because we're taught at such a young age that we have to be perfect at everything, right? We have to, if you come home and as a young kid and you don't get an A on your spelling test, well, you don't win the prize, right? If you missed one word, you don't win the prize. You missed that soccer goal, you didn't win the game. Well, you know, too bad, we'll get them next time. But in the world of trading, it's not about being right 100% of the time. It's about being right and capitalizing on when you are right and letting the market and being okay with the losses that you take. And when the market structure shifts and when it changes, you're going to take losses. So recognizing it early is paramount. Getting and switching your positions from maybe a personal bias, like I'm in a bunch of buys, the market's going down, and I really need it to go up, we get kind of stuck in what I call personal bias, where we need the market to do something that it may not be structurally going to do, but because we're new traders, we don't care about that. We just want the market to do what we need it to do. And sometimes the market is the worst teacher in the world, where it will actually do what we want it to do. And then we get ingrained in the thought or belief system that, see, I was right all along. All I got to do is just hold on to my trades, and eventually they work out. That is the wrong way to think, and it requires reprogramming of the brain to be like, okay, structure just happened. My trades are breaking down. I need to lighten or get out. Most of the time, we're doubling down on our position because the proof is we have to be right, right? And so basically coming and understanding the market changes, market structure, when that does change, well, those of you guys who are there trying to figure it out, well, congrats, because that is ultimately the next evolution in your trading. And that's a huge, huge step. It's the hardest thing, but it's a huge step to get to that point. And it's something that we can all learn from and get better at on the daily basis. Okay, so let's take a quick look, and we're going to start out with Martin's trades here. Martin gives me an example of trading on the 13th, February 13th, so a little bit ago. So he's trading on the 13th to the 14th. So this is his analysis. So let's just look at it. So he entered into 35 trades here. And he, at the end of the day or at the end of his trading session, it looks like he took a loss on his pips, but he was actually up positive. So the first thing that tells me is that he got himself into a situation where he was losing. He started out light, which is great, and that's awesome. And then he started losing in that position. And then he flipped to some heavier trade setups and won on those. So he executed on probably a win while losing trade. And we're going to go look at his plotted trades in a second and see if I'm right on that. But that would be my first initial reaction to what he did, right? So those are the days where you actually take a loss on pips but are positive on your daily return. So then sometimes that's just called fighting the market. And if that was the case, congratulations, Martin, because sometimes those are the best days that you don't take a huge loss and you learn to get out, right? So just kind of looking at overall, just for that day today, again, the average, his amount of positive profit was $42. All right. So now let's go ahead and let's look at his plotted trades here. So the first thing that I'm seeing right out of the gate, kind of adhering to some rules, is that we get this price cycle up. Then we have a price cycle down. And one of my hard and fast rules for me personally is I never place a trade in the same direction at the end of a price cycle, because this happens to me all the time. So at the end of a price cycle, so if a price cycle is down, I tend to never get into sells at the end of a price cycle. There are exceptions to every rule, but we're going to focus on the rules in this trading review. That you never want to get into a sell at the end of a price cycle. If anything, right here, we should have been buying just because of that rule. Now, I would not have said, let's buy because it's going to go up, because that would be hindsight. But I would say, let's buy until it hits this point right here. And I'm going to move that until it hits this point, because this is at the end of the buying price cycle. So right here is the end of buys. So I'd buy into this, and this would be my action point. And we talk a lot about that in Discord. So if you don't know what that is, join us on Discord and you'll quickly understand what that action point is. But I would look at for this action point on the buys. And if it tells me to get out, I get out, right? But then I think what happens to a lot of us and most of us, this happens to, is where we don't get out, or we place the wrong decision here. We place our sells here and it's wrong. And then we start building into a position of sells because we want them to be right? And we want them to be correct. Then what happens is the pop tops, pops the top off of the top of this, and it continues to run against us. Well, now you're into what we call avoiding the max loss. And I did a YouTube video on this as well. So avoid the max loss. And what that is where we got to look for a way to get rid of these trades or reduce our exposure to the market by avoiding the max loss so that we don't take a huge bath in the market, right? So once this happens, once it crosses over here and we're already into sells, well, personally, I would have traded this by waiting for a 3-bar reversal, or what I call a confirmation signal, to put more sells on after it crosses this, okay? And I can't really tell that with this because you don't got these candles. I don't really read these type of candles they don't trade with these, this candle version. And so I can't really give you insight as to the bodies and the wicks. And that's what I use a lot for determining when that 3-bar reversal happens. But basically the rule is that the moment that you get a candle on, so it's going up, going up, going up. The moment that you get a candle that crosses the body of this, sorry, this is probably going to be better. The moment you get a candle that crosses the body right here, that's your confirmation that you should start selling. Okay. That's the confirmation that we should get into selling. And that is right here. So for you to, so I'd hold, if I was into sells right here, which you are, I mean, I would have been in buys, and then I would have probably waited for a bounce up and got into some sells for the bounce down. But if it bounced up and then continued to go up, then I sit and I hold a light position until I get the confirmation or a big wick candle that's an exhaustion bar, and I start to sell off of this. So I start to sell off this, and I use these sells that I make here to fix these guys here. The moment that it comes down to this action point right here, I would have gotten out of everything, right? And that's where you get out of everything, and that's the rule, right? So regardless of the direction that you're in, if you're in a situation that you're losing, you wait for the price cycle down, for one price cycle down, and you get out of everything at hopefully what we call a break-even trade. And if it does go past this just a little bit, then you start making a little bit of money. And that's how you get out of your trades right here. And it looks like you kind of did that, executed a little bit. But you also did something that I would not have done. Again, you got in, it looks like the same issue here is you got into some buys right here at the end of a price cycle. I'm just going to end a PC. So you got into some sells right here at the end of a price cycle. Then you got into some buys at the end of the price cycle. And I think that, not to be too harsh on you, Martin, but this is what I call chasing the market. So this is what I call chasing the market as opposed to predicting the market. Okay, when we're at the end of a price cycle, 9 times out of 10, it's going to stop at the end of a price cycle and turn and go the other way for at least one price cycle. And if you don't know what I'm talking about as far as price cycles, watch the video that Khalid put on this channel that talks about how often price cycles run. And how many price cycles they run. Very, very great video that I think is a prerequisite to understanding this rule of never buying at the end of a price cycle, right? And so by learning that, this could have saved your whole trading session just by learning that one simple rule is to never place a trade in the same direction at the end of your price cycle, right? So that being said, this is how I would have traded this market. So right here off this action point, I probably would have started to buy. I would have bought off of here, layered up into my buys until it crossed here. Then I'm not buying anymore. I'm in profit mode. So this is profit zone for this buy stack or these buy trades, right? Unless it comes down and gives me another opportunity, but it didn't here. So I'd get out right here, depending on the action point, and then I would be looking for a first retracement sell of a breakout. So it breaks up, comes back. I would be looking at either selling to this action point, and if it fails to cross this action point, then I would get back into buys, right? Because it's probably going to go a little bit higher, and I'd start working back into buys. Again, can't really see where I'd get out, but my rule is I'd work into buys depending on the action point that is left of this. So I'd widen out my view to see where that is. And if it is no, there is nothing, no data that way, then I would turn that into a ride the wave situation. And I would just get out when the ride the wave situation ended. And I'm kind of thinking that would have ended somewhere in here, right? So if that ended somewhere in here, that's how I would have traded out. I would have exited out of my buys. And then I would kind of look and see, okay, then I would probably trade either the fib off this move right here, see if it's going to fib that move. And if it fails to cross here, again, going back to market structure, we just talked about it. Market structure is key and paramount, that if it fails to cross that and you start turning into higher lows, getting these higher lows forming into the market, well, you could just have yourself a nice little marching market or a channel that's running off of this, right? And so that's exactly what happened. So the biggest takeaway from here, the biggest takeaway for you from me is never placing a trade at the end of price cycles. Yes, these trades worked out for you, but you also, if you are in a bad position, you avoid the max loss. And and by getting out of your sells here, by entering into sells here, would have helped you to get out of sells there. And then you could have shifted if it failed to cross this market structure point. Now, there's a lot of information coming on you all at once, a lot of different things. So I'm going to just pull it back to one or two things, Martin, for you. Look for the opportunities to not place a trade, to always get into trades. Never place a trade at the end of a price cycle in the same direction, meaning end of price cycle, do not get into sells. That's going to save you more often than not. If it doesn't, and let's say you buy here, say you enter into buys and you just see continuation, then you jump into the avoid the max loss and WWL because it's going to go 2 price cycles against you. Because it's going to go 2 price cycles against you, you build into another position of buys for the 1 price cycle move in your favor, and you win while losing, and you avoid the max loss. That's the way that I typically tend to trade all the time. Those are the rules. There's exceptions to every rule when you trade. Not every single day is going to be like that, but generally speaking, that's a hard and fast rule to never place a trade at the end of a price cycle in the same direction of that price cycle. It's going to save you. I honestly think it'll save you a lot in your trades. So now let's jump over and let's see what Jerry has in store for us on his trades. All right, Jerry, I'm just going to make a couple of assumptions here that this is the Euro USD and this looks like a 1-minute chart that you've been trading. And right out of the gate, let's kind of zoom into this area here. Going back to what I was just talking about with Martin, is that you placed a trade right here at the end of a price cycle, which is a dangerous trade to do, particularly once you get this broken to the bottom and you place a sell here. If you place a sell here, that goes back to chasing the market, not predicting the market's next move. This one right here, you missed out on a high probability trade setup. So to me, I would be off of this breakout. This is what we call the first retracement of a breakout. And almost always I am fading this sucker and I'm buying off of this candle because it's larger for an attempt back to touch this. Now, it never reached that. It doesn't necessarily have to. It just has to go to 50% of that candle. And that's all I needed to go to. And if it does go beyond that, it's probably going to go 100. But at 50%, that's where I get out of my heavy, high probability stacks where I'm just smacking the trades on to see if I can get into as many as I can while this wick is forming, right? And because that's a high probability trade setup that I take every single time I see it. And so right there, I'm going to say you and I we're just opposite of that, right? You're selling, I'm buying right there on a high probability first retracement of a breakout. I'm buying off of this move. You sold, it comes up. There's nothing wrong with this other than the fact that there's nothing wrong with your thought of being into a sell. Although you wait for this retracement to happen, then you get into a sell right here. You see if it does in fact cross that 50%. If it crosses that 50%, well, guess what? It's probably going to come all the way up to here. That's where you get into that sell. If it fails to cross that 50%, go ahead and get into that sell here. But this is not the place to put that sell on, right? To me, I'm hitting home this point because it is a major, major, major point that I see a lot of traders do, is that they trade at the end of a price cycle chasing the market, and this flip-flop your brain. This is a high probability setup for buys. This is a great place to buy, and it's not great to sell, right? Because you could have bought here. You could have bought here off of this wick, go up to the 50% line, closed out, sold here, and if it did in fact go to 100%, you could have built into a selling position for another retest of the low, and you could have 2x'd or 3x'd your trades right there. This area right here is generally where I pull out 1% the easy way. Really, really easy right here because of these moves. So just the fact that you didn't see it, I'm spending a little bit of time so that you can hopefully recognize that and see that later, that's the proper way to play that, as opposed to, what you did, right? This one, however, was a perfect execution, okay? So you got out of this trade's done. Then it came down, and the market came down right here. You saw this big old candle coming all the way up, and you sold off this candle. Great job. Great execution. It came down to this action point, and it came down. I think it looks like it crossed this action point, and once it crosses an action point to an outside range, Jerry, then to an outside range, meaning that you have no more action points to your left, then that's when you should have gotten out right when this green candle body appeared on a pullback, and even greater than 50%. You could have gotten out once this candle closes higher. It never did close higher. And so because it never closed higher, you could have held on to these trades into a ride the wave situation to get that close right here. And that's where that green candle closes higher than the white candle. And this is where you should have closed these trades. Now, because you closed early, I think you were thinking, well, here's my action point. It's probably going to bounce up, but then it just had some continuation. So you bought here, which is fine for the logic, but you bought after it had, you bought on a wick, right? And so I would wait for confirmation, particularly because it's an outside range. So not to buy on a wick on an outside range, and I would have probably played the ride the wave situation as opposed to a coming back up because it broke into the outside range, right? And that's just, again, going back to market structure, understanding what type of market that you're in and how you play that game in the market structure. Okay, so it goes down, you bought right here, and it came all the way back up, and guess what you didn't do? This is your X out or your break even point on these trades, because that's the action point that you should have executed on, right? These trades were good, but you got them in right here and you got out here. So the only thing that I'm thinking that you're thinking right here is that I'm going to get into these trades and I'm going to see if they'll go up to here. And you're like, oh, well, it crossed over with the wick, so maybe it's going to go a little higher. I'm going to hold on, and then all of a sudden, nope. It not only went higher, but it came back. And this is the other thing that I see a lot of traders do, is they don't take they take the max loss. They take the max loss, but they don't take the max wins. And it's never, ever, ever, ever a bad thing to bank money into your account. So you want to bank money, and bank money all through the trading, right? And just keep banking money. And so it's never a bad thing. So this is your action point right here. And you would have got out of all of these trades and these trades for profit. But instead, what traders do is they don't recognize that this is a major action point and a major bounce point where really I should get out. And if the market does, in fact, continue to go higher, that's all right, because I got my money, right? Instead of saying, oh, if I would have just held on. Because when you say that to yourself, oh, if I would have just held on, I could have made a lot more. You're also saying to yourself, oh, if I would have just got out, I would have made a lot more. And so never, ever tell yourself, oh, if I would have, right? No, be fine with taking the X, hitting that X, and getting out where the market tells you to get out. And if it does something that you should have or could have, eliminate that from your brain right now. Eliminate that from your thought process A good trader will never say could have or should have. They'll be like, oh, well, I missed that opportunity, but that's all right because there's another opportunity coming down the pipe, right? It's coming really, really, really soon. And because it's coming really, really soon, you can identify that, what you did right here, what you said, okay, it fails to cross 50%. So I'm getting in to my trades and I'm holding on and I'm going to see if it crosses this. Well, good job, because this candle just kind of blew past this action point. The body closed higher. So then it tells me that it's going to run up, and you got out right here, right at that 50% mark of that candle, right? And so that was a great exit. Again, a great exit. And then you saw this action point right here, which is I'm going to get into a sell down to this action point, and it crossed this with didn't even phase it, just kept going down. The only thing I would say to this is that this would have been your next action point to get out, right? Because it crossed this, there's a good chance it's going to come down to here. That's where you should have gotten out of your sells right there on this action point, right? So, but overall, I'd probably grade this out as a B. Right in here, I'd probably grade this out as a C right in here because you missed the high probability trade setup. And if you would have executed these to an A, you probably would have had yourself at least 1% or more, depending on how much you were trading with. But in this area, definitely you should have yielded 1% or more if you would have graded out an A. So hopefully that makes sense. All right, now next little bit. I'm going to look in here. Again, I think you started to sell here, which isn't bad, which is great. You started to sell here because you're like, okay, I'm going to sell off the top of this. It's probably going to be a bounce. Now let's take a look here. Yep. You got your rule of 1, 2, 3 that you kind of missed on. So here is 0 where it formed that body. Here's the 1. Here's the second opportunity. And then here's that third opportunity. Okay. Now again, rule of 1, 2, 3. 1, don't trust it. Probably going to bounce the other way. 2, wait for confirmation. Trade lightly because it could break. If it does not break and it pulls back and it goes for a third test, we should always load up because it's high probability trade that it's going to break. So here, should have told you that this is the third test. I don't sell. I need to buy here, right? Knowing that, you could have anticipated the breakout right here, rode that all the way up to this action point, and probably been done trading, okay? So those are just the two things that I'm seeing right out of the gate, is that you're just missing out on a few high probability trade setups. I really don't want to dissect your trading much anymore because I'm just going to call out 1 or 2 things that I think you should work on. And those 1 or 2 things right out of the gate are going to be, 1, identifying when a area breaks out into an outside range and how to trade that with the ride the wave rule setup. I did a video on that about riding the wave. So understanding, watching that video on the ride the wave rules, and you turn into a ride the wave once you have no more data to the left. That's your true outside range. So understanding that, putting that into your arsenal, learning how to execute on that properly is going to help you ride that wave, and also it's going to help you to identify or maximize profit potentials while mitigating losses. Plus, you also missed out on 2 opportunities for the first retracement of an outside range. So this is the first outside range that happened right here. And you missed on the first retracement pullback of that outside range, high probability opportunity off of this candle. And then it broke again right here for another first retracement opportunity, which is right here. And it kind of broke out again and had another opportunity for a first retracement. So those are the 2 things, Jerry, that I would say that you need to work on, is identifying when to get out when you're in a ride the wave situation, how to execute on that, and learning how to add that first retracement pullback. And then for good measure, learning the 1, 2, 3s when it comes to attempting that breakout. How many times is it attempting to break? Is this the first attempt, second attempt, third attempt? Oh, third attempt. I'm probably going to play in that direction. Now that normally is going to come on that third attempt. So when it's up against an outside range, those 1, 2, 3s don't come into factor because it could break and run at any time. Where those 1, 2, 3s come into factor is when it starts to trade in a range and it's going to break up in higher, right? So you're already in the range and it's going to break up into, and it's not a ride the wave situation. That's when you get the 0, 1, 2, and 3, those attempts. So you just got to, again, understanding market structure. When do you play this technique versus when do you play the reversal, first retracement of the reversal breakout, right? Or the, not reversal breakout, but first retracement of the breakout. So those are the two different techniques that I think, again, if you incorporated all three of those things into your arsenal of trading, learning how to recognize those, learning when to see them, you're going to be way better off trying to predict the market, follow market structure, than if you were trying to chase the market. Hopefully those two things help both of you guys, Martin and Jerry. Thank you again for winning the contest that we had in Discord. Guys, if you didn't win, well, I'm going to throw those out periodically. We certainly have challenges in Discord. So take a look and see in Discord. We are underway on the 1% a day club. So those of you guys who are in the 1% a day club, congratulations to everybody that is posting their 1% every single day. For the person that has the most consistent wins or most consistent posts in the month of February, we're going to do a free hot seat with you guys where I'm going to trade one-on-one live with you. And then next month, we're going to have something different. We're going to focus on more of, instead of the day, we're going to focus on being up on the week. So being consistent at the end of every week. So hopefully you guys have found that this is helping. I'm going to continue to try and throw contests at you guys to just kind of encourage success. Ultimately, that's what we're here for, is to help lift one another up and to eventually get to where we need to go together as a trader. Now, whatever that is, that's answered to you guys. But again, appreciate it. Appreciate the opportunity to help you guys get to where you need to go. And also appreciate that you guys are on the Discord channel and helping everybody else. So thank you, Jerry, again. And thank you, Martin. Hopefully this little picking apart your trades has been beneficial. And we will see you guys in the trade room in the morning.